The world remembers where it was on 9/11/2001. It was a day of fire dust and incomprehensible loss. But in the days just before the towers fell, a different kind of signal was flashing. It wasn't a warning siren or a frantic call. It was a quiet digital echo in the stock market. On 9/6/2001, just 5 days before the attacks, something strange happened. The volume of these bets, known as put options, leaped to more than 20 times its normal level. Then, on 9/10/2001, the same thing happened with American Airlines. To understand the core of this mystery, you first need to understand the tool that was used. The financial instrument at the center of it all is called a put option. The name sounds technical, but the idea is simple. A put option is essentially a contract. It gives you the right, but not the obligation to sell a stock at a set price before a certain date. Think of it like buying insurance on a stock's value. You pay a small fee, called a premium, for this right. If the stock price falls below your set price before the expiration date, your option becomes valuable. You can sell the stock at the higher, agreed-upon price, making a profit from the fall. Let's use a clear example. Imagine American Airlines stock is trading at $30 per share. You believe something bad is going to happen that will cause the stock to crash. So, you buy a put option that gives you the right to sell American Airlines stock for $30 anytime in the next month. This option might only cost you $1 per share. Now, fast forward a week. A terrible event occurs, and the stock price collapses to $18 per share. Your option is now incredibly valuable. You can use your right to sell shares at $30, even though they are only worth $18 on the open market. The difference, minus the small cost of your option, is pure profit. A $10,000 bet could easily turn into $60,000 or more. This is why put options are the preferred tool for those who might have inside information about bad news. The potential for profit is enormous, and the initial investment is relatively small. It's a way to leverage a small amount of capital into a huge return if you can accurately predict a stock's decline. For most people, buying these kinds of options is a wild gamble. The chances of a stock crashing dramatically in a short period are usually very low. That's why the options are cheap. They are like lottery tickets that rarely pay off. It would be incredibly foolish to bet a large sum of money this way. But what if it wasn't a gamble? What if you knew the lottery numbers in advance? If someone had advanced knowledge of the attacks on 9/11/2001, buying put options on United, buying put options on American Airlines wouldn't have been a risk at all. It would have been a guaranteed payday. The suspicious activity did not happen in a vacuum. It unfolded over several days, creating a timeline investigators would analyze. The story begins on Thursday, 9/6/2001. On that day, the Chicago Board Options Exchange recorded a massive and unusual purchase. Put options on UAL Corp., the parent of United Airlines. 4,744 put options were traded, compared to an average daily volume of just a few hundred. 96% were traced back to a single U.S. investment advisory firm. But then, on Monday, 9/10/2001, the day before the attacks, the market surged again. This time, the target was AMR Corp., the parent company of American Airlines. More than 4,500 put contracts were bought on AMR, many times its daily average, most expiring in October, paying out if the stock fell below $30. Again, the focus was not on Delta, not on Southwest, not on any other airline. It was squarely on American. The activity wasn't limited to the airlines. Other strange trades were flagged. Morgan Stanley and Merrill Lynch saw abnormal spikes in puts in the days before the attack. When markets reopened on 9/17/2001, the devastation was immediate. UAL's stock plummeted 42%. AMR's stock plunged 39%. Those who bought puts days before saw their value multiply overnight. The timeline of trades looked to many like a breadcrumb trail, so statistically unlikely it begged for an explanation beyond mere chance. Was it a stunning coincidence? A case of traders getting lucky on bad news? Or was it the financial footprint of a terrible secret? Yeah, this is where the questions start. While the raw numbers of the trades were suspicious, a deeper statistical analysis made them look even more extraordinary. The most compelling work came from a University of Illinois finance professor named Alan Poteshman. In 2006, he didn't just look at volume. He filtered the noise, focusing on puts bought to open, clear bets on decline, benchmarked against history and market conditions. He concluded the put buying in United on September 6th and in American on September 10th was in the 99th percentile. An extreme outlier. Even after accounting for analyst downgrades and broader market moves, the signal remained statistically significant. He didn't claim a smoking gun. Instead, he wrote that the activity was consistent with investors trading on advanced knowledge of the attacks. It was taken seriously by the highest levels. The Securities and Exchange Commission, the FBI, and congressional committees launched massive investigations. They chased down trades, interviewed brokers, and sifted through mountains of data. The verdict, presented in the 9/11 Commission report, no evidence that anyone with advanced knowledge profited from securities trading. United's 9/6/2001 spike was traced to a single U.S. advisor, name redacted, managing billions. They cited a bearish industry view and even bought 115,000 AMR shares on 9/10/2001. AMR's 9/10/2001 spike was linked to an options hotline newsletter sent to about 2,000 subscribers recommending the exact October $30 puts. Editor interviewed, reasons redacted. The mystery extends beyond the airlines. Other unusual financial activity also raised red flags, especially in insurance and reinsurance. Munich RE, one of the world's largest reinsurers, experienced a sharp spike in volatility and trading volume in the days before September 11th. There were spikes in puts tied to World Trade Center tenants, adding another layer to the puzzle. The SEC found plausible explanations for many individual trades, but taken together, the coincidences strained credulity for some observers. Then there is the persistent story of the unclaimed millions, about $5,000 in profits reportedly left sitting, untouched. Why walk away from millions? Some concluded the traders were afraid of scrutiny or of a direct trail to involvement. Officials suggested legal and administrative hurdles, freezes during broader terror finance probes, and hard-to-trace owners amid chaos. Still, the image of blood money left on the table remains a powerful, unsettling part of the 9/11 trading mystery. So, where does this leave us? We are left with two conflicting narratives. On one side, extraordinary coincidence, bearish sentiment, analyst downgrades, a newsletter, no links to terrorism. For officials, the case is closed. On the other, data that won't fade, laser-focused airline bets, suspicious insurance activity, and analyses consistent with foreknowledge. The trail is cold. The full truth may never be known.